Hey there! Today, we're diving into one of the most underrated topics in the world of investing, how exactly the key interest rate affects bonds. This video is for anyone who wants to understand why bond prices can suddenly drop or rise, even if the issuer is solid and trustworthy. We'll break down how a rate change can either make you money or wipe you out, why the coupon isn't the only thing that matters, and what to expect when the central bank decides to go on the offensive. Watch till the end to find out how to lock in a high yield while everyone else is losing money. And don't forget to like and subscribe. New investors often approach bonds the same way they do stocks. If the company's doing well, then its securities must be safe too. But with bonds, the main factor isn't news, earnings, or reports. The most important variable is the key interest rate. Bonds aren't shares in a business, they're debt. When you buy a bond, you're basically lending money to a government or corporation and getting a fixed interest in return. When the central bank raises rates, it makes money more expensive. That changes everything. New bonds suddenly offer higher returns than old ones. Investors start ditching the older bonds, even if they used to seem safe. As a result, their prices fall to compensate for the lower yield. This adjustment happens automatically through basic supply and demand. And the opposite is true too. When rates drop, older bonds with higher yields become hot property and their prices shoot up. But why does this happen? And why is it such a fundamental rule in the bond market? Check out our Telegram channel. We post updates about new videos and articles there. The link's in the description or the pinned comment. Now let's say you bought a bond at 100% of its face value with a fixed coupon of 7%. While the key rate is 4.5%, you're in a great position, earning more than inflation and more than most savings accounts. But if the rate suddenly goes up to 6%, things change. The difference between your yield and the new rate is now just 1% instead of 2.5. So, investors start looking for better options and sell off older bonds to buy the newer, higher-yielding ones. If you want to sell your bond, you'll have to drop the price. Say you sell it at 99% of the face value instead of 100. The buyer still gets a 7% coupon, but now based on 99, not 100. That means their real yield goes up. That's the compensation mechanism. The market adjusts prices to level the playing field. The higher the rate, the bigger the discount on older bonds to keep them competitive. But the price sensitivity also depends on another key factor, how long it is until the bond matures. The longer the time, the more the price swings when rates change. Why? Think of a bond like a fixed-term bank deposit. Imagine you lock in a 3-year deposit at 7%, and then 6 months later, the bank starts offering 9%. Who's going to want to buy your old deposit now? Exactly. Nobody, unless you offer a discount. That's exactly what happens with bonds. The fixed coupon acts like an anchor. It doesn't change. But the price of the bond itself can move. That's how the market adjusts to new conditions. When rates rise, prices of older bonds drop to bring their yield in line with new ones. This hits long-term bonds harder because they're stuck with that old coupon for years to come. So the discount has to be bigger. Now, if you plan to hold the bond until it matures, you'll still get the full face value. In that case, the market price doesn't matter as much. You care more about the yield to maturity. So why do some bonds drop only 1% when rates go up and others fall 10%? It all comes down to maturity and a key metric called duration. Duration is the average time, weighted by cash flow, that it takes to get your money back from the bond, measured in years. The longer that time, the more exposed you are to changes in the economic climate. There's also modified duration. It tells you how much the bond price would change if the interest rate shifts by 1 percentage point. So, if the modified duration is 5, a 1% rate hike could lower your bond's price by around 5%. Picture this. You've got a bond with 10 years until maturity. If rates go up next year, your bond still pays the same coupon until the end. But new bonds on the market will offer more, so yours becomes less attractive and has to sell at a bigger discount. A bond that matures in a year won't be affected nearly as much. So, long-term bonds are way more sensitive to interest rate changes. That's something to remember when building a portfolio, and it's worth looking at the yield curve. That's the graph showing how yield changes depending on time to maturity. If the curve inverts, meaning short-term bonds pay more than long-term ones, that's often a warning sign for a coming recession. History has taught us plenty of lessons. In the 1980s, the Federal Reserve in the U.S. cranked the rate up to 20% to fight inflation. Bond prices crashed. Long-term bondholders lost up to 30% of their value. But those who bought at the bottom made a fortune when rates eventually dropped. Similar things happened in Brazil, Turkey, and Poland. A rate hike always shocks the market, but it's also a golden opportunity for those who can think a couple of steps ahead. We just published a new article on our website. You'll find free content there about stocks, bonds, and ETFs, from beginner to advanced level. Check it out and bookmark the site. Now, if you expect rates to fall, do the opposite. In that case, long-term bonds are gold. If you buy one with a 9% fixed coupon and then rates drop to 6%, your bond becomes a superstar. Everyone wants it, and the price goes up. Bonds with floating coupons are a lifesaver when rates are unstable or rising. Unlike fixed-rate bonds, floating-rate bonds are tied to the key rate or the interbank lending rate. So when rates go up, your coupon grows too. That's a huge benefit in volatile and uncertain times. The bond market isn't just a bunch of numbers, it's a living ecosystem. Supply and demand constantly react to economic policy changes, and the key rate is like the conductor of this orchestra. When the rate goes up, money gets more expensive. Banks raise interest on deposits. Companies have to borrow at higher costs. Investors shift from old to new bonds. Demand for fresh issues grows, and older bonds lose value. As an investor, you shouldn't just sit back. You need to stay engaged. Understand how fast the market reacts, which bonds are most sensitive, and where the real profit opportunities are. It's also key to track what the central bank says and watch macroeconomic indicators. Inflation, GDP trends, the currency market, all of that affects rate decisions. If you can read the signals, you won't just keep up with the market, you'll be ahead of it. For example, rising inflation expectations often lead to rate hike expectations, which means investors start selling long-term bonds in advance. And if you're holding long-term bonds and the rate suddenly jumps, don't panic. First, ask yourself, are you planning to hold until maturity? If yes, no problem. But if not, you might face losses. In that case, consider reshuffling your portfolio. You could sell some bonds and switch to shorter ones or those with floating coupons, or even move into cash temporarily and wait for rates to stabilize. Smash that like button and subscribe to the channel. If you want to support our content, check out the membership platform. Links in the description or pinned comment.